Good morning. Today I want to present financial leverage and trade of equity. Financial leverage incurred when companies use debts in financing parts of its assets. And now, in this schedule, I want to explain when the financial leverage using financial leverage is good or positive or bad or negative. In this schedule, we have two cases, and I let a selective case for you. We have here return on assets 12% and 8%, and the interest rate paid for borrowing fund is 15%. From this point, we lose, but you should take in your consideration a tax rate 40%. So we need to compute adjusted interest rate, net effect of interest rate on borrowing funds. I multiply 1 minus tax rate. So we have 15% multiplied by 1 minus tax rate 40% equal 9%. 9%. So you can now compare between the adjusted interest rate with the return on assets. We borrow money with 9% and we get from the sources invested from borrowing money is 12%. So we have positive financial leverage. In the second case, we pay 9% and we get from their assets or resources only 8%. So it is a negative financial leverage. Now I want to go fast to financial leverage in evaluating alternative of sources funds trade of equity. We have here example. Assume that from ALQAM Corporation 2020 I want to establish a new company, and assume that the total assets is 1000, and I think that I suppose the expected earning per share net income before interest and tax will be 200 or 200, and tax rate is 40%. Manager اللي هو أنا of this corporation have three alternatives to finance its assets. The first item is without any bonds. Without any bonds. There is no bond, there is no borrowing funds, only from stocks, from owners' capital share. The second alternative is 50% from bonds with 10% interest rate, and the other amount from our capital share. The third alternative is 75% from bonds at 10%, at 10%, at 10%, sorry, at 10% here and at 10% here, and the other 25% from capital shares. Required, find the effect of each alternative and put your conclusion to select which alternative is more best. First of all, look to this schedule carefully. We have three cases. The first case is zero borrowing funds, the zero leverage. There is no leverage here. Here we have 50% bonds at 10% and 10%, yes, at 10% interest rate, and we have in case 3 75% and 10%. Okay, total assets at the three cases we assume it as $1000. bonds now البونز عندي here لو بدي اعمل معادلة الميزانية total assets equal liabilities plus owner's equity. So we have bonds here 0, here we have bonds here 575 750. So the capital shares will be the residual 1000 here and 500 and 250. Earning before interest and tax for the all cases is 200, 200, 200. Now I want to compute interest expense for each case. At the case 1 we have 0 bond, so 10% multiplied by 0, so we have 0 interest expense. At the second case we have 10% multiplied by 500 bonds, so we have 50 dollar interest expense, and so on for the case 3. Now we compute income before tax equal 200 minus 0, 200 minus 0, 200 minus 50, 200 minus 75 equal 200, 150, 125. Tax expense 40% from the question, so we can multiply 40% multiply by 200 by 150, 125 equal tax expense will be 80, 60, 50. So the net income for 3 cases as follows: 120, 90, 75. Now we can compute easily return on assets and return on common equity. Please apply the equation of assets and return on assets and the equation of return of common equity. Now I want to apply the equation for case 1. Return on assets equal what? Yeah, the مناسرة. Return on assets equal net income. Net income how much? 120 plus interest expense 0 multiplied by 1 minus tax rate 0 over average total assets. How much average total assets? Where is our average total assets? Is 1000. So 120 over 1000 equal 12%, and you can compute the calculation for other cases easily. Return common equity for the first case is net income minus 0 over average equity. The average capital share is 1000, so we have return on assets and return on common equity as the same, because there is no interest expense and there is no preferred shares. Now you can compute it for the second case and the third case. From the following schedule we can discuss the results as follows. The return on assets for 3 cases as the same, because what? Because the return on assets does not differentiate between sources of funds. Okay, it only focus on the total assets. So we have return on assets as the same in the 3 cases. And again, go back to the effect of interest rate on return on assets. As you know, my student, from the last lessons, we know that return on assets not affected by the changes in interest rate, but return on common equity we have in the case 3 is more profitable from the point of view of owners. So we should prefer the last alternative. We know that the last alternative is more risky, because the debts is 750, while in the second case is 500 only. to the debt ratio to asset debt to assets ratio is more high, more risk, but more profitable for owners. If you are a risky person, you should select and prefer the last alternative. In the next lecture, we want to get you a comprehensive example. How can we compute and select between alternative through long equation and another approach to select between alternative of funds. Thank you for your listening. See you soon. For any comments, please contact me through or via Blackboard email. Thank you.